The AI boom really does have a $170 billion debt story, just not the lazy version where every loan near a server rack gets tossed into one giant panic number. The strange part is that AI looks like software. It arrives as a chatbot, a coding tool, or a suspiciously confident summary, but underneath that tidy interface is an industrial build-out. Advanced chips consume enormous amounts of power. Keeping them useful at scale requires cooling, high-speed networking, backup power, and connections to the grid. The whole operation also needs land and data center buildings that cost real money long before they produce reliable returns. Notebooks and optimism are cheap, industrial infrastructure is not. That timing gap is where debt enters the story. Companies are buying the future before the future has agreed to pay them back. They spend now on assets intended to serve future demand, generate revenue, and eventually earn a return. Borrowing and other financing bridge the distance between today's invoice and tomorrow's hoped-for cash flow. When the assumptions work, leverage can accelerate a useful expansion. When they do not, hype can turn out to be leverage wearing a nicer jacket. Now for the precise headline number. In a video published on June 29, 2026, Goldman Sachs said the four biggest technology companies had issued more than $170 billion in corporate debt year to date. That figure is not a complete count of all AI debt. It covers that specific corporate issuance, not the wider financing system. That broader system also includes private credit, project finance, leases, special purpose vehicles, and other debt-like obligations. The real issue is not whether debt is automatically bad or whether AI demand is imaginary. It is whether expensive assets can earn enough soon enough to cover interest, upgrades, and repayment without depending on permanently perfect conditions. So we are going to separate the technology story from the financing beneath it, follow how the build-out is funded, and test the repayment assumptions against lower utilization, expensive energy, aging chips, and tighter refinancing. Innovation may be real. The invoice has excellent attendance. Start with the order in which the money moves. A company does not wait for a data center to become profitable and then purchase the data center. It has to secure land, construction, electrical equipment, cooling, chips, and network capacity first. Suppliers and contractors expect payment during the build. Revenue arrives later after capacity is installed, customers sign contracts, workloads migrate, and usage becomes steady. Even then, revenue is not the same as free cash flow. The facility still consumes power, requires staff, and needs maintenance. The costs arrive as a committee. Mature revenue takes the scenic route. That gap can be especially wide in AI because demand forecasts are doing a lot of work. Capacity takes time to build, so operators must decide today how much compute customers might want several years from now. Build too little and they miss sales. Build too much and expensive hardware sits underused while interest keeps accruing with admirable punctuality. A provider can therefore report rapid revenue growth and still consume cash because it is building the next wave before the current wave has paid for itself. Growth can be genuine while the financing pressure is also genuine. This is why the limited corporate issuance figure and the wider financing ecosystem must stay separate. Corporate bonds issued by four large technology companies are one visible category. They are obligations of those corporate issuers with their own maturities, rates, and credit support. The broader build-out can also be financed by banks, private credit funds, infrastructure investors, equipment leases, real estate partners, utilities, and special purpose entities. Some obligations sit directly on a technology company's balance sheet. Others belong to a data center developer or project company and are supported by contracts, assets, or expected payments. Adding every category into a single confident total would be enthusiasm pretending to be precision. The distinction matters because different structures put risk in different places. A bond backed by a large company's overall cash generation is not identical to a loan secured by one facility. A long-term lease is not identical to unsecured borrowing, even though both can create fixed future payments. project finance may isolate a particular development, but its success can depend on construction schedules, tenant commitments, and operating performance. The relevant question is not merely how much money entered the system, it is who owes what, under which contract, and what cash flow is expected to meet the obligation. Why use debt at all? Because waiting can also be expensive. If demand is growing and competitors are reserving chips, land, and power, delaying construction may mean surrendering capacity and customers. Existing cash flow can fund part of the expansion, but even highly profitable companies may not want to drain cash reserves or starve other parts of the business. Equity is another option, yet issuing shares dilutes current owners and can be unattractive when management believes the company's future value is higher than today's market price. Debt lets a company spread the cost through time while preserving ownership. That can be sensible when the financed asset produces durable, predictable cash flows. The first pressure point is the interest rate. A higher rate raises the cash cost of borrowing and lowers the return left for owners. It can also reduce what lenders are willing to advance against the same expected income. A project that looked comfortable when money was cheap may become merely adequate when refinanced at a higher rate. If the debt has a fixed rate and a long maturity, the company may have time. If it resets, matures soon, or depends on repeated financing rounds, market conditions can hit the company before the project reaches maturity. Refinancing is not an accounting footnote when the repayment plan requires it. It is part of the operating model. Then comes utilization. Data centers earn attractive returns only if enough capacity is used at worthwhile prices. A full facility and a half-empty facility may have similar construction costs, but they do not have similar economics. Demand in a particular region, or for a particular operator or hardware generation, may fall short of forecasts even as demand for AI services grows overall. Customers might optimize their models, switch providers, negotiate lower prices, or adopt new chips that perform more work with less capacity. None of that requires AI to fail. It only requires the financed asset to earn less than expected. Broad technological success does not guarantee that every owner of infrastructure receives the same reward. Energy adds another layer because power is both an operating cost and a physical constraint. A facility may secure chips before it secures enough reliable electricity to run them. Grid connections can take years, and power prices can vary by region and contract. Cooling costs move with climate, design, and workload. If energy becomes more expensive than forecast, margins narrow. If power is unavailable, utilization cannot reach the forecast at all. A server without electricity is an unusually costly sculpture. Depreciation and obsolescence make the timing harder. Buildings and electrical systems may serve for decades, but advanced chips can lose economic value much faster. New generations may deliver better performance per dollar or per unit of power. Older hardware can remain useful, yet the price customers will pay for it may decline before the financing attached to it disappears. Accounting depreciation estimates how an asset's cost is spread over time. Economic obsolescence asks the ruder question: how quickly does the market stop valuing this exact capacity? If the asset ages faster than the debt balance falls, the lender still has a claim while the underlying equipment becomes less competitive. These pressures interact. Lower utilization reduces revenue. Higher energy costs reduce the margin on that revenue. Faster obsolescence demands more capital spending just to remain competitive. Higher interest rates raise the cost of replacing or refinancing existing obligations. A company may respond by cutting prices to attract usage, which helps utilization but can weaken margins further. Or it may slow expansion, which protects cash but risks losing customers. There is no requirement for a dramatic crash. The risk is a gradual narrowing of choices until management is spending more time defending the financing structure than improving the product. That slow squeeze is more plausible than the cartoon version in which the entire industry wakes up bankrupt on a Tuesday. Revenue can keep rising while free cash flow disappoints. Contracts can be renegotiated, maturities extended, assets sold, and projects delayed. Trouble may therefore appear as lower returns, repeated capital raises, or reduced investment rather than instant collapse. The central risk is not necessarily that the technology vanishes, it is that the cost of owning the capacity consumes more of the value the technology creates. Financing structures also differ too much for a single verdict. A profitable platform company with diversified revenue, substantial cash, and long-dated fixed-rate bonds has options that a speculative developer with one customer and floating-rate debt does not. A facility backed by a firm long-term capacity contract may have a clearer repayment path than one built mostly for expected demand. A lease can transfer some construction or residual value risk while creating a different fixed commitment. The same headline can therefore describe companies with very different margins for error. That does not mean the risk is unknowable. It means analysis has to reach below the headline. 3 questions do most of the useful work. What asset is being financed? The answer should be more specific than AI. Is it land, a building, grid equipment, chips, or contracted computing capacity? And how long is that asset likely to remain productive? What is the repayment path? Look for operating cash flow, customer commitments, parent company support, asset sales, or an explicit need to refinance. What assumptions would break the model? Lower utilization, weaker pricing, construction delays, higher power costs, faster chip replacement, or a higher refinancing rate can each matter. If repayment requires fast growth, stable costs, and accommodating lenders all at once, the plan has confused a forecast with a support system. So the opening debt story resolves into something less dramatic and more useful. Innovation and the invoice are not opposing claims. They arrive together. Better models can increase demand, and that demand can justify enormous investment. But the value created by the technology must still be divided among customers, workers, suppliers, power providers, landlords, lenders, and owners. The financing structure helps decide who gets paid first. Timing decides whether the cash arrives before obligations tighten. Growth expands the opportunity, but cash flow determines how long a company can keep pursuing it on its own terms. This is a framework for understanding financing risk, not personalized investment advice. The point is not to declare every borrower doomed or every data center a mistake. It is to look past the size of the promise and inspect the structure carrying it, ask what was financed, how it pays, and which assumptions cannot afford to fail. AI may change a remarkable amount of the economy. It does not change the basic arithmetic of interest, maturity, and cash generation. The future can be innovative, useful, and profitable. It can also arrive with leverage. And however exciting the growth story becomes, cash flow is still what keeps those very expensive servers running.